Budgeting can skyrocket not just hotel room revenue, but profitability as well. Did you know that? Well, are you then missing three proven budgeting tricks that will take your revenue achievement to a new level? Let's find out how and why. Before we dive into the three proven budgeting tricks to take your room revenue management to a new level, you may be asking a question, why me? Well, I spent 26 years in the hospitality industry. And during that time, I would have gone through more than at least 20 annual budgeting exercises. And in all of those budgeting exercises, I learned some invaluable lessons. I would like to share those with you as I go through the three proven budgeting tricks that I talked about. It's because if you stick to those budgeting techniques, you will wonder how you managed without them. And at the end, you will come away with the definite realization that budgeting is not the necessary evil you thought it is. It's one of the most powerful revenue management tools that a hotel manager can have at their disposal. So let's jump right in. I would urge you to watch the video all the way to the end. Why? Well, I'm going to provide you a surprise bonus. Let's begin with the why. What's the big deal about hotel room revenue? Well, the big deal is that 3/4 of hotel profitability comes from room revenue. That is why room revenue is such an important part of the hotel's revenue management strategy. Are you budgeting the wrong way? You may ask a question. What is a wrong way? Well, if you are budgeting incorrectly, it's likely that this room revenue increase is not going to happen. Worse, if you do budgeting incorrectly, your profitability also will disappear. Now I think I've got your attention. So, budgeting is a very important process leading to hotel revenue and profit achievement. It's one of the key elements of the revenue management strategy of a hotel. So let's dive into the three secrets of budgeting so that you may earn the highest room revenue possible. First, capacity defines revenue. So we are all talking about room revenue, but much before you talk about room revenue, you need to understand capacity. And what is capacity? Capacity is simply rooms available as far as room revenue is concerned. For example, a hotel which has got 300 rooms available is different from a hotel which has 500 rooms available. Obviously, the 500 room hotel has a higher capacity. Later, you will see why this capacity is such a critical factor in not just revenue achievement, but profitability retention as well. Secondly, the rooms available limits the room revenue that can be achieved. Let me illustrate. Assume that rooms available are 300. It's possible that the room revenue can be to the extent of $100,000. While if the rooms available are 500, that same room revenue could go up to $250,000. That's 150% higher. So, room revenue in a way is defined by what rooms available a hotel has. And that's part of the budgeting equation. Thirdly, rooms available influences something more important than revenue, and that is yield. Now, you might ask, what is yield? Let me give you an example and explain what yield actually is. If you achieve a room revenue of $100,000, while you could have potentially achieved a room revenue of $250,000, yield is thus calculated as actual room revenue divided by potential room revenue and multiplied by 100. In this case, yield is 40%. So, every hotel with a different rooms available is likely to achieve different room revenue and therefore yield. We will understand more about yield in a later video. Are you budgeting for a higher yield? If you are not, you are leaving money on the table. It is important that in your budgeting process, you factor in these rooms available so that your room revenue budget is realistic. A majority of managers just jump into a room revenue budget. They do not consider rooms available or the capacity as a factor. And that's a huge mistake because, as we saw earlier, capacity literally puts a limit to what room revenue that can be achieved. Number two, revenue is driven by two factors: occupancy and ADR. Let's take a look at each one of them. Occupancy directs the operation. What do I mean by that? What I mean is that if a hotel is running a 50% occupancy, it has a different level of activity than a hotel which is running 90% occupancy. So obviously, a 90% occupancy hotel has more challenges than a hotel which is just running at 50%. Are you budgeting for a higher yield? I'm repeating the question because, again, occupancy is a factor that affects revenue, which affects yield. Next, the second factor that impacts revenue, the first factor was occupancy, which we just saw, is average daily rate. And average daily rate directs market position. What do I mean by that? Market position can be anything from market share, revenue share, elements that determine where your hotel is positioned in the market you operate. We are going to be seeing market position and market share in later videos. Now let's take an illustration. Let's say average daily rate for a hotel is $200. Your room revenue could be, say, $100,000, limited by that $200 average daily rate, or ADR as it's known as. On the other hand, if your average daily rate is $350, your room revenue could potentially be $250,000. Now, it's clear that a hotel with an average daily rate of $350 commands more room revenue than the hotel which has $200 Thirdly, revenue per available room, or RevPAR as it's globally known, optimizes yield. You saw how yield is such an important factor in the revenue management strategy of a hotel. Well, revenue per available room enhances it. So, what's revenue per available room? Let me illustrate. Let's say rooms available is 200, occupancy is 50%, and an ADR of $400. Your room revenue would therefore be $40,000. How did we get that? Well, rooms available multiplied by occupancy percentage multiplied by ADR will result in room revenue. In this particular case, as you can see, it's 200 rooms available multiplied by 50% occupancy multiplied by $400 ADR equaling $40,000 room revenue. Now, room revenue could be $50,000 and rooms available, say 200. What would revenue per available room be then? Well, RevPAR, or rooms available, would be room revenue divided by rooms available. And that would be $50,000 divided by 200, giving you $250 RevPAR. Now, the question again, are you budgeting for a higher RevPAR? Because if you are just budgeting for either occupancy or ADR, your room revenue is not optimized. You are not earning the highest room revenue possible. In other words, a higher RevPAR achieves higher yield. Ensure that your focus is on the RevPAR and not just one of the two, which is occupancy or average daily rate, in the process of budgeting for room revenue. As I've said earlier, many managers focus on just occupancy percentage or average daily rate. They do not take RevPAR as a major factor in budgeting for room revenue. That's again a huge mistake. Why is that? Because RevPAR is what is known as a composite measure. It balances occupancy and ADR, thereby producing optimum room revenue for your hotel. Number three, the room revenue we are talking about is built on the foundation of what is known as market segments. Market segments firstly represent your target audience. It's your customer. So market segments are critical in building room revenue. So let's take a look at a couple of common market segments. There's an individual market segment category, which mostly consists of business customers, and a group market segment category, which mostly consists of leisure customers. Note that I say mostly. It's possible that the individual market segment may have some minor leisure customers, or the group market segment might have some minor business customers. But the majority of individual market segment would be business customers, and the majority of the group market segment would be leisure customers. Then, market segments differ in occupancy and ADR, which we saw earlier, right? So, how does that play out? Well, individual market segment, which mostly is about business customers, could say have an ADR of $350 with an occupancy percentage of 65%. Group market segments, on the other hand, which predominantly consists of leisure customers, could have an ADR of $200 with an occupancy of 15%. Now, note the differences between the two market segments. And that brings us to the next important budgeting practice. Target RevPAR in your market segments. So taking that same example, if individual market segment is mostly about a business customer and has an ADR of $350 with an occupancy percentage of 65%, your RevPAR would then be $350 multiplied by 65% equals $227.50 as RevPAR for the individual market segment. For the group market segment, which are mainly leisure customers, the ADR is $200 with an occupancy of 15%. That results in a RevPAR of $30. Now note the difference between the two, how occupancy and ADR influence RevPAR. The individual market segment RevPAR is 7.5 times more than the group market segment RevPAR. Obviously, you know where your focus in budgeting should be. It's not as if you're going to ignore group market segment, but your bread and butter is the individual market segment. In your budgeting process, make sure you make RevPAR as the focus for each market segment that builds up to the room revenue. In a way, what I'm saying is when you budget for room revenue, go to the market segment, determine the occupancy percentage and the ADR, but also calculate RevPAR so that you're aware of where it stands in the overall room revenue contribution. As I've said before, a lot of managers just jump into a room revenue budget without building it from the bottom up from market segments, which means using RevPAR in each market segment. Let's now recap the 3 budgeting secrets, which 3 of its own sub-secrets, if you want to call it that. Capacity, RevPAR, market segments. These are the 3 proven budgeting tricks, techniques that will deliver the highest room revenue for you. And now to a bonus secret, which is known as the powerful 80-20 rule. You may ask, what is the 80-20 rule? Well, the 80-20 rule says that 20% of effort produces 80% of results. If we apply that to our room revenue budget, you should be focusing on your top 3 market segments in your budget. Why? Because per the powerful 80-20 rule, they will deliver 80% of your room revenue. That should be great motivation for you, right? Well, if you want to know how to do that, meaning how do you use market segments to build your room revenue budget, click on the video above on market segments.